So you think you want to be a real estate investor, do you? Don't you? What all's included in that? That's what we're going to talk about today. This is Jessica Duncan's Just My Opinion, and I'm Jessica. There's no handbook to owning a home, so I go beyond the transaction to share my opinion, tips, and insights for adulting made simple. So you think you want to be a real estate investor. It sounds like a great idea. I get calls all the time from customers that say, hey, I want to start investing in real estate. How do I get started? What do I do? We're going to talk about a lot of those details. There's a lot of things you need to think about and plan for in being an investor. So the first thing you really need to think about is how much risk am I really comfortable with, right? So, and this is in any investment, not just real estate, but you're going to have to put up some money. How much are you comfortable with? How much are you comfortable risking? What is your variable on risk? Some people want to be very moderate, very conservative. Some people are like, I don't care, risk it all, put it all on black, right? So you got to determine your own comfortability with risk to determine what type of investing you're really comfortable with doing. And so the next thing that once you figured out that risk, you really got to think about is where's the money going to come from? So how are you going to have the money to invest? Are you going to take money out of a current investment, whether it is a property, doing a home equity line of credit or refinancing to pull out money out of a current mortgage, which I'll tell you, both of those I'm not a huge fan of, especially based on the way the rates are right now. And just for timing purposes, this is, late 2024, early 25. Based on the current interest rates, I'm not really comfortable with that, right? So we want to think about how much money is that costing you as well. What I really like is for people to have a cash amount that they're comfortable investing. And even if we're going to do some what I call leveraging, otherwise finance, but I call financing leverage when it's making us money, right? It's not just financing for no reason. Buying a car, you finance it and make payments. It's not making you money, right? That's not leveraging. That is debt. When we're talking about buying an investment that's going to make you money, I call it leveraging, and it's very, very different. So you got to figure out where's this money going to come from and how much do I have to start out with? You don't always have to have 100% cash. There are times it makes sense to invest in property and finance a portion of it. Different times, there's different parameters that you want to look at because the real estate market is constantly changing over the years. And we're going to talk about how you look at judging an investment and whether it's worth it. And that's really going to play into whether or not you finance it. So you want to think about your risk that you're comfortable with and where's that money coming from. Step one, step two. Once you figure that out, then you're really comfortable to move forward with your goals. So what type of goals do you have with this investment? I know you're thinking just make money, right? No, there are so many other reasons to invest. We have people who will buy second homes down here in Florida because their goal is to eventually retire here and live in that home full time. And so they want to go ahead and invest money in it, whether prices are lower, so that, 5 or 8 years from now, when they want to retire, they already have that home paid for, whatever their situation is. So there are reasons besides cash flow that people actually want to invest in. Maybe it's to own a future home there. Another reason why people could want to invest is because maybe they want to buy a condo or a beach house that their family can enjoy over the years, but they don't want to worry about the cost associated with that. They want an investment that their family can enjoy, but also the cost and the upkeep and the maintenance can be covered by that investment. So they're not having to put out as much money throughout the whole year to support that property. Another reason that people invest is just pure investment, right? So that's the traditional form of investment. I just want to make money on it. I don't care how much money or how I make money, but I got to make money. And I can't tell you how many times when I sit down with customers, I say, well, what's your goal in investing? What are you trying to achieve here? There are many times they don't know. Well, if you don't know that, it's really hard for me or any good agent to advise you on what you need to do to invest in real estate. I got to know your goals. I got to know your risk comfortability. I got to know how much money you have to put into it so that I can make sure you're making an investment that you're going to be comfortable with. So now that we've identified your comfort level, We've identified where the money's coming from. We've identified your goal. Let's talk about how we're going to determine, is this a good investment, right? So there are many different types of investment properties. So the ones people think of quickly are normally residential real estate, right? Residential long-term real estate. You can also invest in commercial real estate. So commercial real estate that you rent out on a monthly basis, but they're normally 2 to 3 year long contracts or leases. So you have residential real estate long-term, you have commercial real estate long-term, and then what became really popular during COVID, but then it sort of died off a little bit, is short-term investments. There's 2 different breakdowns on that. So you have your really short-term, which is going to be 7 days or less. And then you have what's more of a midterm, which could be a month at a time to 3 months at a time. And that's when you think about traveling nurses, corporate relocations, things like that. So short-term rental is going to be less than 7 months in Florida because we have that bed tax here that we have to think about. So anything less than 7 months in Florida, but then could it be a midterm? Could it be a short term? What really is the goal here? A short-term rental may be great if it's a property that your family wants to enjoy on a regular basis, maybe 3 or 4 times a year. Short-term rental can supplement the cost of that property to help you be able to enjoy it while also letting someone else pay for it or even cash flow you some money. And then another type that we don't hear about as much is purchase and hold. So a purchase and hold investment really works great for land. But let's say you've got some cash that you need to move into an investment of some sort. You're really not worried about the return on it right now. You're thinking further ahead. Land is a great place for that, to invest money in land that the future value is going to be worth more than it is now. So it's not going to have a monthly return. You're not going to see any fruition from that until you go to sell it. And it's a long-term strategy. There are many very successful people who have made some great investments that were able to anticipate growth in certain areas, anticipate things like interstate exits being added and things like that, that have really made some great investments, but they may have taken 10 to 15 years to ever come to fruition. And you got to be really comfortable with that level of risk and being able to put money someplace and not worry about making anything on it in the interim. And that's not everyone. So now that we've determined what you're comfortable with on risk, where your money's going to come from, your goals on investing, your investment strategy style, now let's talk about how you're going to evaluate this investment. Is it a good investment or not? You've got to decide how you're going to evaluate every investment. And this is very unique. So I work with a lot of investors. I'm personally an investor, and everyone tends to do something different. I don't know that there's a right or wrong answer. So I'll tell you at the end what I do, but I'm also going to tell you a little bit about what other people do so that you can decide what's right for you. So certain investors are really big on cash flow. So they say, look, I don't care what it costs. I don't care what I got to put into it. I just want to know that I can cash flow $300 a month or $400 a month, whatever their cash flow goal is. They want to make X amount of dollars a month, and that's all they care about, right? So what do I mean by that? So they have to look at what if they're leveraging, meaning financing. If they're financing, minus what they're getting in revenue, minus the financing, minus the expenses, how much are they left with at the end of every month? And so when you're talking about this and investments, I'm a big proponent of putting back money for the upcoming expenses. So for an example, when I rent out a property, if it's an older property, I'm going to put 10% back of that rent every single month for the maintenance that has to be done on that property. Every time someone moves out almost, you got to paint walls. Sometimes you got to replace flooring. ACs have to be replaced over time. Roofs have to be done. So I put back 10% of every property, especially older properties, every single month for those unexpected or planned expenses. Really, they shouldn't be unexpected. But you got to decide what you're going to do on cash flow there. What are you comfortable with? How much do you want to see coming in every month? And that's just one strategy. Another strategy that's probably similar to what I actually do is, what is your ROI or return on investment? So when you look at this, it's how much am I putting out versus how much am I making off of it? And so the way I do my strategy, it's a little different. I don't care if I'm financing, if I'm paying cash, how much output did I have? So how much cash am I putting out on the property? And then how much money am I making on the property every year minus all expenses? So that includes, cost of property management, any improvements I'm going to do on the property to be able to make it rentable. That is going to go into my cash out of pocket. I'm going to include that 10% back for improvements, whether it's painting, flooring, things like that. So you look at how much you put out for the property. That's my initial investment. How much I invested in the property and improving it. And then I'm going to look at how much it is making each month minus my expenses. So how much am I profiting each month? So if I have it financed, I'm just deducting my actual mortgage out, right? And considering how much I'm earning each month on it. And then I'm going to take that initial cash output and that annual return and figure out what percentage that is, right? So that's my return on investment. So here's an easy example. If I put $100,000 out to buy this property and I am making 10% on it per year, that would be $10,000, right? So if I put out $100,000 and finance the rest, or just bought it $100,000 cash, and I'm making, after all expenses, $10,000 a year, I now have a 10% return on investment. I would love to get 10% on everything. My general rule is I want to make at least 8% on any investment because I still have the actual asset, right? That's increasing in value. But my minimum standard is 8%. Some people are higher. If I can make 10% on something, I'm doing it all day long. Every now and then I get lucky and find one that's a 13 or 14%. And that is a total no-brainer, right? But you got to decide what your return on investment is. I don't like to go into lower than 8%. So if I'm only going to make 5% on my investment, why not just put it into a CD? That's sort of my strategy, right? Because at 5%, I still have risk. There's still risk associated. Every time you rent out a house, you got to worry, whether it's short-term, long-term, you got to worry about damage. You got to worry about hurricanes. You got to worry about having to evict someone. There's so many things. You're opening yourself up to liability. So if it's not worth the risk and the profits aren't, then why would I do it? So if it's less than 8%, to me, I don't want to move forward with it. But you got to decide for yourself what's important to you. But that is the strategy of return on investment. The next is $1 per square foot. So this is one I've heard for years, is basically when I want to rent out long-term and I want to get $1 a square foot. There are so many places in our area that would not make sense. So you can have a very small condo that $1 a square foot wouldn't cover your HOA dues at each month. You could be actually losing money if that's your strategy. But there's definitely some areas that does work for, and $1 per square foot is how they think. Another way is future value. This is very hard for people to understand, and a lot of our waterfront property, especially on the island, a barrier island, Pensacola Beach or Perdido Key or Navarre, this is how you have to look at investing in these properties. And some people don't understand it, but it's not looking for monthly cash flow. You buy a property that's in an area that is scarce, right? There's not a lot of property. What happens when there's not a lot of similar like properties that are highly demanded? They grow in value. Our beach is pretty full on Pensacola Beach. There's only like 3 lots you can build a condo on left because of the restrictions of it being a barrier island. Navarre Beach has a lot of land left to build on. So these are 2 different areas that beachfront property can be valued very differently. But when you look at scarcity, you know that over time, if it's highly demanded and it's highly rare, it's going to grow in value, right? So when you buy a beachfront property here on a barrier island, my goal is to try to cover the cost of that property over 10 years, right? So there are going to be years I'm going to make money renting it out. There's going to be years a hurricane's going to come through and I'm going to lose money renting it out because I'm going to have to improve it. I won't be able to rent it for a long period of time. I'm going to have assessments if it's a condo for roofs and insurance costs and things like that. But what I want over 10 years is for that property to break even. And this is a great strategy to use if you're looking for a second home or something your family can use, especially if it's in an area you like to vacation or visit. So I'm looking for not making any money on it. So how is it an investment? Jessica, you said we're going to talk about investments. I'm not making any money on this. How is this an investment? Well, it's in a rare area. It's a highly demanded product with very few of them. So over the 10 years, the value should go up. And when you sell the property, the equity you have in the property is where you make your money, right? So it's future holdings that you are going to be able to cash out at some time. That's the goal with a lot of the investment properties on our beaches. A lot of people don't understand that. And they're like, well, I want it to cash flow. And I'm like, don't get caught up in cash flow, because you may cash flow for a couple years and then you may not cash flow for a couple years. And I want to make sure you're in this investment for the time it's going to take to really make a good return on investment on it. So that is a whole nother strategy. Not for everyone, but it depends on your goals. We got to go back to those goals. And what were you trying to achieve with this initial property? So how do you want to get there? How comfortable are you with that risk? And we'll end up finding the right one for you in the end. So let me tell you about a customer that I worked with. When I first started working with this customer, they had invested a lot of money in property. And they had a pretty good portfolio with a pretty good return on investment. But after I looked at it, at this particular time, interest rates were really low. That changes everything. This doesn't always make sense, but rates were really low. And as I looked, because they had paid cash for all these properties, they really were limiting their return on investment, where they could have leveraged and took 4 properties into 8 properties and doubled their monthly income. So after looking at the portfolio, I made some recommendations, and we were able to sell some properties, buy some more properties, and completely change that portfolio. Now, keep in mind, we used the exact same out-of-pocket money. We just redistributed and leveraged to make their income so much more. It was 4 times what it initially was. So that is the key to how much is this money making me versus what am I getting out of it? How much have I invested? What am I getting out of it? And so you really want to think about that. Many times when I've talked to investors about their comfortability with long-term investments on the beach, they really thought they were going to cash flow. So there are many times I sit down with a customer and I'm like, let me be honest with you. This is not going to cash flow. Are you comfortable with this? And they're not. And that's okay. Let's find an investment that you are comfortable with, that you can move forward with, because we go to work to make a living. We buy real estate to build wealth, and they are 2 total different things. And so first part, though, I do want to add, whether you're thinking about being an investor now or in the future, number 1 priority, you want to buy your own primary residence. There are many people I meet with that say, oh, I want to become an investor, but they've never bought their primary residence. You need to buy your primary residence first, because right now you're building someone else's wealth, not your own wealth. So that's step 1. You don't have to have it paid off, but you need to actually buy your first house. So it's time for this week's home hack. And a home hack is an app, a gadget, or a tool that you didn't even know you need, but makes life a little bit more simple. So this week's home hack is actually my Excel file of how I determine a good investment. So if you would like it, please hit me up in the DMs and I will send it over to you. It's nothing fancy. It's just an Excel file that helps me determine very quickly, is this a good investment and do I want to put my money in it? So it is a file that you very simply add in purchase price, how much money you're going to put into the property, whether you're financing or not, and it'll quickly shoot out that rate of return so you can decide, does this make sense and do I want to move forward with it based on your current goals and comfortability with investing. So if you've enjoyed the podcast today, please make sure you subscribe so you never miss an episode. Also, if you have any questions, send me a DM on Facebook or Instagram. We'd love to answer them on the podcast. Hit me up with your question and I'll let you know when we answer it. Remember, it's just my opinion.